Imagine making nearly $1 billion, like in pure profit.
Right, just a massive amount of cash.
Yeah, and doing it in just 90 days. Now imagine that instead of using that massive windfall to, expand your empire or open new offices, you just shrink.
You pull back?
Exactly.
Yeah.
You deliberately shrink your business. You take, 94% of that cash, and you use it to buy back your own stock.
Effectively taking your chips off the table.
Yes. Taking the chips off the table. On the surface, that makes absolutely no sense. It goes against every instinct we're taught about corporate growth.
Oh, completely.
Yeah.
The default setting for most management teams is just blind expansion. Growth for the sake of growth.
But that logic completely flips when you're analyzing a business that, knows a storm is coming, and they know exactly how to prepare for it.
Yeah, it's the ultimate test of corporate discipline. What we are looking at today is a company that understands that sometimes the most profitable action you can take is to just step back.
Refuse to play.
Exactly. Refuse to play the game until the odds are back in your favor.
So welcome to a brand new deep dive. We have a really fascinating mission today. We are unpacking a pretty dense corporate event.
Very dense.
Yeah. The Q2 2026 earnings conference call for Arch Capital Group Ltd. For you retail investors out there, that trades under the ticker symbol ACGL.
And our goal here isn't just to read you a spreadsheet, right? Or give you a standard accounting recap.
No, absolutely not. We're using this specific earnings call as a masterclass. We want to extract the playbook of a multi-billion-dollar insurance and reinsurance giant.
Because we want to show you exactly how massive financial institutions navigate, geopolitical chaos.
Shifting global economies.
Right. And the total unpredictability of Mother Nature. The raw numbers from this quarter are really just the surface layer.
The real value for you listening is dissecting the decision-making architecture behind those numbers. The framework Arch uses to allocate capital.
Because that framework can be applied to almost any sector of the global economy when you're evaluating risk.
Okay, let's unpack this. We have to start with the sheer scale of the capital we're talking about. The headline numbers are wild.
They really are.
In this quarter alone, Arch Capital generated $893 million in after-tax operating income.
Which translates to $2.56 per share.
Nearly $1 billion in operating profit in a 3-month window. And while that headline number is staggering, we need to look at what they are actively doing with that mountain of cash.
Right, because it tells a very specific story about where we are in the current global economic cycle.
So the defining action of this quarter was their share repurchase program. Arch basically acted as a massive liquidity vacuum for its own stock.
Yeah, in Q2 alone, they repurchased 12.4 million shares.
Yeah.
Which cost them $1.2 billion.
And if you look at the first half of the year in totality, their total share repurchases hit $1.95 billion.
That is where that 94% figure comes in.
Right. They took approximately 94% of their net income and used it to shrink their outstanding share count, which, I have to push back on this a bit.
Go for it.
I view this through the lens of a high-stakes poker game.
Right.
If you are sitting at a table and you've built up this massive stack of chips, you don't just fold every hand and slowly cash out.
Unless you look around and realize the blinds are getting way too high.
And the other players are getting reckless.
Yeah.
But why would a company making this much money aggressively shrink its footprint instead of, pushing its advantage?
What's fascinating here is, if we carry your poker analogy forward, Arch is looking at the table and realizing that the potential pot no longer justifies the risk of the hand they're being dealt.
Okay, so the math is changing on them.
Exactly. This is driven by the mechanics of the insurance cycle. Unlike tech or consumer goods, the insurance industry breathes in and out in these really distinct cycles.
And we've spent the last few years in a very pronounced hard market, right?
We have.
Let's define that for everyone. A hard market being an environment where insurance coverage is scarce, supply is constrained, and therefore insurers hold all the pricing power.
Right, they can charge massive premiums. And in a hard market, insurance companies post incredible margins. The risk-adjusted returns are phenomenal.
But capital is inherently attracted to outsized returns.
Exactly. As Arch's management explicitly noted on this earnings call, we are now entering the early stages of a softening market.
Okay, so the outsized profits of the last few years have acted like a magnet.
Yes, drawing in an influx of new capital and new capacity.
So you have hedge funds, private equity, rival insurers. They see the profits. They flood the market with their own capital to back new policies, and suddenly supply outstrips demand.
And when capacity increases, prices naturally get driven down. Top-line growth starts to slow. because you simply cannot charge the same premium for the exact identical policy you wrote 12 months ago.
The market becomes crowded.
Yeah, and the terms and conditions of policies start to loosen as competitors just fight for market share.
Which brings us back to their discipline. A lesser management team, maybe one whose, compensation is tied to sheer revenue growth, would keep writing policies even as prices fall.
Just to show Wall Street an upward trending chart.
Right, just for the optics. But Arch is effectively folding their hand. If the premium doesn't mathematically justify the risk of the payout, they just refuse to write the policy.
Which is incredibly hard to do in practice.
It is. But if they aren't deploying that capital into new risk, it just sits on the balance sheet, dragging down their return on equity. So they return it.
But the mechanism of how they return it is really interesting here.
Yeah, in the transcript, management noted that back in 2024, they were returning capital through special dividends, but now they're entirely focused on buybacks.
The shift has to be tied to their valuation multiples. It is entirely mathematically driven by their price-to-book ratio.
And book value is basically the foundational metric for valuing insurance companies, right?
It is. In 2024, Arch's stock was trading at roughly 2 times its book value.
Okay, so the market was pricing the company at a 100% premium to its actual net assets.
Right. And at that valuation, buying back your own shares is incredibly expensive. You're essentially overpaying for your own assets.
Which destroys value for the remaining shareholders over the long term.
Exactly. If you are forced to pay $2 for every $1 of asset value, buybacks are a terrible use of capital.
Yeah.
So in 2024, they issued special dividends instead.
Putting the cash directly into shareholders' pockets.
Yes. But let's look at the current environment. Management noted on the call that the stock is now trading in a range of 1.45 to 1.6 times book value.
So the premium has contracted significantly.
It has. And at this lower multiple, taking that $1.95 billion and buying back shares becomes highly mathematically accretive.
It boosts the underlying value of every remaining share.
Exactly. You are retiring equity at a price that enhances the book value for whoever is left holding the stock. And the proof is in their results.
Yeah, Arch's book value per share grew by 2.8% in Q2 alone and 4.5% across the first half of the year.
They are manufacturing shareholder value not just through underwriting, but by actively manipulating the denominator of their share count.
Right, at the absolute optimal point in the valuation cycle. So they're acting as dynamic capital allocators first and insurance providers second.
That's a great way to put it.
But, that naturally pulls us into the actual business they are writing. Because despite this defensive posture and shrinking share count, Arch is fundamentally in the business of holding the bag.
Holding the bag when the absolute worst things in the world happen.
Right. They are a specialty insurer, meaning they take on the risks that standard commercial insurers just run away from.
You are renting out their balance sheet to absorb the world's volatility. And you only really need a specialty insurer when standard statistical models fail.
Which was very apparent this quarter. If we look at the insurance segment, they reported $27 million in underwriting income.
But they made it clear that this number was heavily suppressed by real-world catastrophes.
Yeah, the total current year catastrophe losses were $201 million net. Some of this was driven by U.S. severe convective storms.
Your standard massive hail and wind events.
Right. But the other major driver was the Iran conflict, specifically damage to refineries.
Arch is a leading writer of political violence, terrorism, and marine war coverage.
In the London market at Lloyd's, right?
Yes, exactly.
Now, when I think about modeling risk, I can understand convective storms. You have decades of meteorological data.
Doppler radar, historical weather patterns.
Building codes. You can build a statistical probability curve for that, but geopolitical conflict is driven by human emotion and, state actors.
It's completely chaotic.
Right. I assume it is nearly impossible to build a reliable actuarial table for a war breaking out.
You cannot model human conflict with the same precision as atmospheric pressure. There's no historical data set that accurately predicts the escalation of a regional conflict.
Especially one involving modern drone warfare and shifting diplomatic alliances.
It's unprecedented every time.
So if you can't model it and they just took actual financial losses on refineries in the Middle East, the natural conclusion would be to just exit the market.
For run for the hills.
Yeah. Yet management explicitly stated they are selectively deploying more capacity into the Middle East right now. They're leaning into the very conflict that just cost them money.
It seems completely reckless until you understand how the London specialty market actually functions.
Okay, enlighten me.
You don't model the conflict itself. You model the supply and demand of capital surrounding the conflict.
Ah, okay.
When a geopolitical disaster strikes, the standard insurance markets panic. Standard carriers issue immediate notices of cancellation for vessels or assets entering the region.
So the supply of insurance just completely dries up overnight.
Yes, but the underlying economic activity has to continue, right?
Right.
Oil still needs to move through the Strait of Hormuz.
Refineries still need to operate.
Exactly. So the demand from the clients skyrockets precisely when the supply of coverage vanishes.
And that creates a massive pricing dislocation.
Huge. Arch's management noted that rates for political violence and marine war coverage in the Middle East have multiplied rapidly compared to their pre-conflict levels.
Wow. So they are deploying more capacity now because the risk is finally priced correctly.
Exactly. Prior to the conflict, marine war coverage might have been priced as a tiny administrative add-on to a standard policy.
Just a throw in.
Right. Today, insurers can charge astronomical premiums for a single vessel voyage or a short-term policy on a physical asset.
So they basically wait until the risk is perceived as so terrifying by the rest of the market that they can essentially name their price.
That's the specialty market in a nutshell.
But what about the losses they already took? The $201 million net catastrophe loss includes those refineries.
Management made a crucial distinction about those losses that really highlights their transparency.
Which we like to see.
Definitely. They clarified that the losses stemming from the Iran conflict are based on actual, tangible claims. Case reserves have been set up for physical damage that has already been verified.
So they aren't hiding behind IBNR.
Right. Incurred, but not reported reserves.
Right, IBNR. So in complex geopolitical situations, some insurers will use IBNR to take a massive hypothetical guess at what a crisis might cost them down the line.
Which obscures their current financial reality. You don't really know where they stand.
But Arch is setting hard case reserves. They are saying, look, the damage occurred. We have quantified the claim. The capital is set aside.
And now we are repricing our new policies based on this new reality.
Which offers a really fascinating lens for you as a retail investor. If you want to understand how pure free market economics react to global conflict, the news will give you the emotional narrative.
But the London insurance market gives you the unvarnished reality.
Exactly. They do not flee from risk based on sentiment. They simply reprice it based on the new cost of capital.
It's ruthless, but it's logical.
It is. But
Yeah.
that introduces a pretty terrifying operational question. If Arch is actively leaning into war zones and absorbing massive U.S. storm losses, how do they ensure a single compounding string of bad luck doesn't just wipe out their entire equity base?
This is where we transition from the front end of the business to the back end. Capping existential risk is the entire purpose of their reinsurance segment.
And how they manage their net exposure versus their gross exposure. I look at this like a massive high-stakes shell game.
It really is.
Let's dig into the reinsurance segment numbers. They delivered $410 million in underwriting income here, which is highly profitable.
Very strong.
They posted an ex-cat accident year combined ratio of 79.9%. I want to make sure we define the mechanics of that metric for everyone listening.
It's vital. It is the ultimate report card for an insurer.
Right. A combined ratio just measures the money flowing out to pay claims and operational expenses versus the premium money flowing in.
It is a simple fraction. If the combined ratio is exactly 100%, it means for every single dollar they collected in premium, they paid out exactly $1 in claims and expenses.
So they essentially broke even on the pure business of insurance.
Right, relying entirely on their investment portfolio to make a profit.
So anything under 100% means they are generating an underwriting profit before they even touch the investment side.
Which makes a 79.9% combined ratio exceptional.
It's massive. For every dollar they collect, they are only paying out roughly 80 cents, leaving 20 cents as pure, unadulterated underwriting margin.
It is an elite margin in this industry.
Mm-hmm.
But the story isn't the margin itself.
Right. It is how they are achieving it while simultaneously shrinking their footprint.
That is the paradox here.
Yeah. The transcript noted that despite this incredible profitability, their net premiums written in the reinsurance segment were actually down 10% year over year.
And the specific reason management gave is that Arch actively increased its cessions.
Its cessions to traditional reinsurance and third-party capital.
Yes, particularly in stressed areas like property catastrophe.
Let's break down that terminology. Ceding risk means passing it on to someone else. It is a Russian nesting doll structure.
I love that analogy.
Thanks. So Arch writes a massive policy for a client, providing the gross capacity. But secretly, behind the scenes, Arch turns around and buys insurance for themselves from another entity.
Slicing off a chunk of that risk and handing it away. The nesting doll analogy is a perfect visualization of this.
Okay, so the outer doll is the gross premium.
Right. Arch wants to maintain its dominant market position. If a major broker comes to them needing a massive property catastrophe program for a Fortune 500 company, Arch does not want to say no.
They want to be the lead market. They want to control the terms, so they write the gross policy.
They provide the massive safety net to keep the client relationship intact.
Got it. But internally, their actuaries know that keeping all that risk on their own balance sheet is too dangerous.
Especially in a softening market where the premium they collected might not be quite as robust as it was a year ago.
So they utilize retrocession.
Yes.
Retrocession being the act of a reinsurer buying reinsurance. It's the next layer down in the nesting doll.
Exactly. They cede a portion of that risk to retrocession markets and third-party capital.
Which brings up a really crucial question. Who on earth are these third parties?
That's the million-dollar question.
Management noted that property catastrophe rates dropped by the mid-teens during the mid-year renewals. Prices are falling. Why would an external entity want to take on Florida hurricane risk when the potential payout is dropping?
And how is Arch facilitating that transfer?
Right. I assume we're talking about massive pools of institutional capital.
We are primarily talking about pension funds, sovereign wealth funds, and specialized catastrophe bond investors.
Okay.
These entities operate with a fundamentally different mandate than a publicly traded specialty insurer. A pension fund manages hundreds of billions of dollars.
So their biggest fear is a systemic market crash.
Exactly. Tech stocks plummeting, interest rates spiraling, corporate bonds defaulting all at once.
So they are desperate for yield that is completely uncorrelated to the broader financial markets.
And a Category 5 hurricane hitting Miami doesn't care what the S&P 500 is doing.
Wow, right. It is a completely isolated risk variable.
Exactly. So Arch packages this risk, often through mechanisms like catastrophe bonds or sidecars.
And Arch takes a fee for originating the business, structuring the deal, and managing the claims process.
While the pension fund provides the capital to back the risk. If the wind doesn't blow, the pension fund collects a nice yield.
But if the wind does blow,
They lose their principal, which pays the claims.
so Arch effectively acts as a toll bridge, passing the heavy volatile risk to entities with a lower cost of capital while keeping the origination fees and a smaller, highly curated slice of the net risk.
And we can see exactly how successful this strategy is by looking at their probable maximum loss, or PML.
This is the metric that keeps insurance executives awake at night.
Oh, absolutely. Arch specifically models a 1 in 250-year event.
They look at the Florida Tri-County area,
Yeah.
Miami-Dade, Broward, Palm Beach.
And simulate a catastrophic worst-case hurricane scenario.
And due to all this seeding and retrocession, their peak zone natural catastrophe PML dropped to $1.8 billion.
Which sounds like a massive loss. But you have to look at the denominator. That $1.8 billion represents only 8% of Arch's tangible equity.
That is wild. So if the absolute worst storm in 2.5 centuries hits the most densely populated, highly insured coastline in the United States, Arch's total exposure is capped at an 8% hit to their equity.
They don't just survive. They open their doors the next morning and continue operating.
If we connect this to the bigger picture, that is the essence of cycle management, right?
Exactly. During previous hard markets, when rates were at historical peaks and the reward for taking on that risk was astronomical, they might have allowed that PML to sit much higher.
Because they were being paid enough to hold the risk on their own balance sheet.
But as they noted, property rates dropped in the mid-teens this renewal cycle. The reward has shrunk.
So Arch aggressively cedes the risk to third parties, driving their maximum exposure down.
As the market softens, their defensive posture hardens.
It is brilliant, but, it relies on an immediate feedback loop. A hurricane hits, you assess the physical damage, you pay the claim, the event is over.
That is short tail risk.
Right. Capping risk on a storm that happens on a Tuesday is the relatively easy part. The real existential threat to a company like Arch isn't a sudden disaster.
It is a slow-moving crisis that takes 10 years to settle.
Which transitions us naturally into their casualty segment and the temptation of what I think is the most dangerous environment in finance right now, the era of high interest rates.
This is exactly where we separate enduring generational financial institutions from the companies that inevitably blow up and become cautionary tales.
Okay, let's look at the numbers. Arch continues to see premium growth in casualty-oriented lines in North America. But the staggering figure here is not the underwriting income.
It is the investment income.
Yes. Arch's investment portfolio contributed a massive $613 million this quarter.
That is $1.56 per share pre-tax.
Driven by a colossal $49.5 billion asset base, strong bond yields, and contributions from equity method funds.
I want to pause on that term, equity method funds, because it really highlights how sophisticated their asset management is.
This isn't just Arch buying government treasuries.
No, under the equity method of accounting, Arch is investing in private funds or companies where they hold a significant stake, usually between 20 and 50%.
Which gives them significant influence over the operation, even if they don't outright control it.
Right. They are recognizing their proportional share of those funds' profits directly on their income statement. It is a highly active, yield-generating strategy.
And with interest rates elevated across the board, that $49.5 billion asset base is throwing off cash at an incredible rate. Now, I'm going to put my shady banker hat on for a second.
All right, let's hear it.
If I am sitting on nearly $50 billion and I can easily generate 5% or more in the bond market and even higher returns in these equity method funds, I am incentivized to gather as much cash as humanly possible. Right?
That would be the temptation.
So why wouldn't I instruct my underwriters to sell casualty insurance policies at a slight loss? Just undercut the competition, price the policies super cheap, grab billions in customer premiums, and invest it.
Because the massive spread on the investment yield would more than cover the slight loss on the underwriting.
Exactly. Are they being too conservative by not doing this?
What you're describing is the siren song of the insurance industry. It has a specific name, cash flow underwriting.
Cash flow underwriting.
And it is the primary mechanism by which insurance companies bankrupt themselves.
Okay, but if the math works on a spreadsheet today, why does it blow up in reality a decade later?
Because of the defining characteristic of casualty insurance. It is long-tail risk. We discussed short-tail property risk, right? A building burns down, the claim is paid in 3 months.
But casualty insurance covers liability.
Yes. We're talking about medical malpractice, construction defects, directors and officers liability, or massive product liability suits.
The client pays the premium today, but the actual event that triggers the lawsuit might not happen for 3 years.
And the lawsuit itself might not be filed for 5 years.
And once it is filed,
it might take another 5 years to work its way through the appellate courts. You are sitting on that risk for a decade or more.
That's terrifying.
Now let's introduce the variable that management explicitly flagged on this call. They noted they are not yet seeing any benefits from tort reform in their loss trends.
Which is a direct reference to the phenomenon of social inflation.
Exactly.
Social inflation being the reality that the cost of legal settlements and jury verdicts is rising significantly faster than standard economic inflation.
Yes. It is driven by several structural changes in our legal system. You have increasing anti-corporate sentiment among juries.
Leading to what the industry calls nuclear verdicts.
Right. Awards in the tens or hundreds of millions of dollars that defy historical precedent. But even more impactful is the rise of third-party litigation financing.
Where Wall Street hedge funds actually bankroll the plaintiff's lawyers.
Precisely. In the past, a plaintiff might settle a case early because they simply couldn't afford the legal fees to fight a corporation for 5 years.
But today, hedge funds pay the legal bills in exchange for a cut of the final verdict.
This allows plaintiffs to hold out for maximum damages, dragging the timeline out and drastically increasing the final settlement cost.
And management noted that legislative attempts at tort reform laws designed to cap punitive damages or limit joint and several liability have not yet translated into lower claims costs in their data.
So bring this back to your shady banker analogy.
Yeah.
If you engage in cash flow underwriting today, assuming that your 5% investment yield will cover a slight underwriting loss, you are making a blind, leveraged gamble on the future of the American legal system.
You're assuming the cost of claims will remain static.
But if social inflation causes a liability claim to multiply exponentially over 10 years, that 5% bond yield you harvested today is completely immaterial.
The $10 million reserve you set aside is suddenly facing a $50 million jury verdict.
And it wipes out your capital base.
Which is why Arch's management was so adamant on the call. They explicitly stated they maintain a strict separation of church and state.
They refuse to use high investment yields to subsidize lower pricing in casualty lines.
They demand a pure underwriting profit on the risk itself. In their internal pricing models, they only credit the risk-free rate.
They price the policy as if they are making essentially zero excess return on the invested capital.
And if the premium doesn't generate a profit under those draconian assumptions.
They simply walk away from the business.
It requires immense institutional fortitude. I mean, when you see your competitors slashing rates to grab market share and your brokers are begging you to match the price.
The pressure to cave is enormous. But Arch's refusal to chase yield at the expense of long-term underwriting integrity is what ensures they will still be operating a decade from now when the cash flow underwriters are insolvent.
As an investor, that is a massive bullish signal for the long-term health of the stock. But, refusing bad bets doesn't generate the billions of dollars needed to fund those massive stock buybacks.
Sure.
If property lines are shrinking due to cessions and casualty growth is carefully restricted by strict pricing discipline, where is the reliable cash coming from?
This leads us to the final and, frankly, the most surprisingly boring segment of their business.
Let's talk about the silent engines providing the ballast for this entire operation: mortgages and M&A strategy.
It is the perfect counterweight. If you operate a portfolio of highly volatile, complex risks, you desperately need a segment that provides monotonous, predictable stability.
And the mortgage segment is exactly that. It delivered $220 million of pure underwriting income.
The statistics here are incredibly stable. Delinquency rates in their U.S. mortgage insurance portfolio remain completely flat at just 2.1%.
That is remarkably low. And they are actually seeing favorable reserve development, meaning the claims they expected to pay in the past are coming in cheaper than modeled.
And they're finding pockets of growth, despite the U.S. housing market being constrained by high interest rates.
Yeah, they signed a massive new client in Australia. They are also reducing their quota share insurance.
Let's define that, because it ties directly back to their capital confidence.
Okay, what is quota share?
Quota share is a form of reinsurance where you agree to share a fixed percentage of every single premium and every single loss with a reinsurer.
So by reducing their quota share in the mortgage segment, Arch is actively choosing to keep more of the premiums.
And therefore more of the risk entirely on their own balance sheet.
Because they look at that 2.1% delinquency rate and realize the risk is incredibly low. Why share the premium if the underlying loans are performing perfectly?
Exactly. Mortgages operate on a completely different macroeconomic rhythm than property or specialty casualty.
Right. A marine war in the Middle East or a hurricane in Florida has zero impact on whether a homeowner in Ohio pays their mortgage.
As long as the broader employment market holds up, this segment just chugs along quarter after quarter, throwing off predictable cash flow.
Which acts as the funding mechanism for everything else. This diversification means that when the property market softens, they can lean on the mortgage cash flow.
And if the housing market eventually cracks, the hard market in casualty lines can carry the weight.
They are never backed into a corner where they are desperate for cash and forced to write bad business.
That structural stability also allows them to be highly selective in their corporate strategy, particularly regarding mergers and acquisitions.
Management spent some time discussing their M&A philosophy, specifically highlighting the ongoing migration of a middle-market commercial business they acquired from Allianz onto their own systems.
They articulated a really clear build versus buy framework.
They explicitly stated they do not buy companies just to gain market share or look bigger to analysts.
No, they use M&A strictly to acquire specific capabilities.
The middle market commercial space is a perfect example of this. We are talking about insuring businesses with revenues roughly between $10 million and $1 billion.
It is a highly fragmented market. It lacks the massive, bespoke complexity of a Fortune 500 account.
But it is much more complicated than a standard small business policy.
Right. It requires very specific underwriting expertise, robust distribution networks with regional brokers, and highly efficient technology systems to process the volume.
Building that from scratch takes years, so they bought the Allianz book to instantly acquire that capability.
But they also noted the massive hurdle of integrating it. Systems migration is notoriously the graveyard of M&A value.
It is where the theoretical synergies modeled by investment bankers fall apart in the real world.
You are taking decades of legacy technology, differing actuarial models, and clashing underwriting cultures,
and trying to force them onto a single platform. The fact that Arch is prioritizing the meticulous integration of this capability rather than just hunting for the next flashy acquisition is just another indicator of operational discipline.
Especially because management was completely blunt about the current M&A landscape.
Yeah, they stated that they view current M&A targets in the market as simply too expensive. The valuations just do not make sense.
Which brings this entire deep dive full circle. It is a perfectly closed loop of logic.
If external acquisitions are priced too high, And internal premium growth is restricted because the market is softening and rates are falling.
What is the single most rational, accretive asset they can purchase with their billions in cash flow?
Their own stock. Because they have perfect visibility into the underlying assets, they know their own reserves are solid, and the stock is trading at a discount to its historical multiple. It all connects.
It is a phenomenal demonstration of a company refusing to fight the economic cycle and instead choosing to aggressively ride it.
So we have unpacked the math, the mechanics, and the strategy, but what does this all mean for you listening right now?
Why should you care about the granular Q2 earnings of a Bermudian specialty insurer?
Because understanding Arch Capital's playbook provides you with a master framework for evaluating risk and discipline.
It is a mental model you can apply to any business you analyze, or even to your own personal financial decisions.
Exactly. When you see a company expanding aggressively into a crowded, low-margin market just to artificially inflate their revenue growth, you will recognize that behavior for what it is.
Reckless capital allocation.
But when you see a company that is willing to quietly shrink its footprint, return capital to shareholders, and refuse to chase yield at the expense of long-term stability, you are looking at true operational discipline.
Recognizing the difference between those two postures is the essence of financial literacy. But while we have praised Arch's reliance on strict actuarial discipline and historical modeling, I do want to leave you with one final, slightly provocative thought to explore on your own.
I love a good curveball. What is the blind spot?
Well, we talked extensively about how Arch models their probable maximum loss. They look at a 1 in 250-year event, like a catastrophic physical hurricane hitting the Florida coast.
And they cap their exposure at 8% of their equity, using historical weather data and geographic isolation.
Right. But as our entire global economy becomes inextricably digital, the nature of a catastrophic event is fundamentally changing.
Okay, I see where you're going with this.
How will financial giants adapt when the next true 1 in 250-year event isn't a storm isolated to a single geographic area?
What happens when the catastrophe is a synchronized global cyber attack?
Or a cascading software failure that crosses all borders, impacts all industries, and triggers millions of distinct corporate liability policies simultaneously?
Wow.
Are our current historical models of risk fundamentally obsolete in a hyper-connected world where a disaster cannot be contained on a map?
That is a chilling thought. A hurricane hits one coast, but a global cyber event hits every coast on Earth at the exact same millisecond.
Exactly.
It is a perfect reminder that the landscape of global risk is never truly settled. There's always a new variable waiting just outside the edge of the model. Thank you so much for joining us on this deep dive. Keep questioning the numbers behind the headlines. Always look for the underlying discipline, and we will see you next time.